Last night I shared a little bit of our story. I'm not going to go into too much detail, except I would have to say I would probably have lost more money than all of you. So why Jim gets somebody like me to get up and talk to you about money and risk management, I guess it's my share of my punishment 10 years later. With that in mind, I said something to the beginners last night which is heartfelt, and that is I don't want any of you to go through a fraction of what Andrew and I went through in 2000. So that's the purpose of this talk, because how much money you make or how much money you lose has got a lot to do with A, the stops that Jim was talking about, and then your money and risk management, and then the third thing is the psychology, and that's what Kath's all about. Now this was put together, summarised if you like, by Dr. Alexander Elder in his first book, Trading for a Living. I think he was the first guy to come up with the fact that there's 3 M's to successful trading. One is your mind, the other is your method, and that's what Jim's been teaching you all today, and the third thing is money and risk management. And they all go hand in hand, and one of the things that Elder said was it's sort of, if you can picture it like a trading stool, you know, and the stool's got usually 3 legs, right? And you need all 3 legs to be rock hard strong in order for that stool to stand up. There is no point in being the perfect analysis of what, you know, learn Jim's system so that you absolutely got it down to every last little dot point if you haven't got the other 2 things in place as well. And so that's what this session's all about, and hopefully you'll gain from it. Andrew's just handed out a little sheet. It's a little worksheet to be done at the end of this session, and I would encourage you, don't bother to fill it in now, I would encourage you to go through that sheet and make it part of your trading plan. Okay? Right, okay, let's go. So, I mentioned a little ditty from Louise Bedford. It was in one of her books years ago now. If you can figure out how to get each little dollar of capital panting with exhaustion by the end of the year, then this will have a dramatic effect on your overall returns, assuming your system has a positive expectancy. What that means is, in fact, we put it in this, you'll find today's newsletter went out today, obviously. You'll find there's a thing in there that what we're talking about here now is making your money work for you, because traditionally we spent, most of us in a job situation, employees or whatever, or businesses, where we're working harder all the time. You know, we're like hamsters on a wheel. And here's a great opportunity now with share trade where you can actually make your money work for you. And there are times when, you know, the money that comes in, for those that are complete novices, the money that comes in can be quite dramatic. It's quite large, to say the least. You know, even if you're making 1,000 here, 2,000 there, and you start pulling all of those in, it adds up. And when you start comparing it to what you can earn in a job situation, even with somebody with a small portfolio, if you make $1,000, then that's pretty significant, isn't it? Will we agree? Right, you compare that, right? How many hours do you have to work in a job to make 1,000 or 2,000 or whatever? And so what Jim has stressed earlier on today's, all through the day, is the fact that the idea is to keep your losses low. So why protect? If a share drops down in 10% in value, it's actually got to go up 11% to get back to where it was. Who realises that? Who didn't realise that? One, okay? Right, take it down to the extreme, and if a share loses 50% in value, it's got to go up 100%. Does everybody understand the logic in that? Not logic, the maths in that? So we mentioned last night, you imagine during the global crisis, most of the indices around the world, a lot of them, shall I say, dropped 50%. Jim's shown Warren's index, what Warren's own Berkshire Hathaway dropped 50%, well, so did a lot of actual whole indices around the world. So when that happened, they actually had to have come back 100% to get back to where they started. So if, you know, the people all around the world were in funds or whatever that were matching those indices, well, it's a long wait to come back up. So if you're going to have small losses, that's what you're looking at, because you don't want these things to happen. That's the cruelty of the market. A 50% loss cannot be made up by a 50% gain.